All right, so we're gonna get started. We're just gonna get started for the night. Welcome everyone. Thank you guys for joining us for our first installment of Food for Thought. For those of you who don't know, my name is Shavante Hope. I am a co-founder of the Dinner Party NYC. The Dinner Party NYC is a networking event series that is run by myself and my partner, Evelyn Jean-Francois. She has joined us tonight. But she's going to be playing the back, and we are going to have Mr. Shakor Jukes, who is joining us tonight. He is a CPA, an accountant, who is going to be giving us some tips on business taxes and just making sure that you're setting yourself up for the best possible outcomes with your businesses, if you own a business, and also just giving you different tips that can help you with your taxes in general that you may not have known before. So again, Food for Thought is the educational component of the Dinner Party NYC. We will be having more classes to come, so stay tuned and share with your friends. But without further ado, I am going to have Shakor introduce himself, and we're going to get into a poll before we start tonight's seminar. Shakor.
Cool, thank you. And while we do this poll, I appreciate everyone joining today. My name is Shakor Jukes. I'm a part of Jukes CPA. I'm the owner there, and I'll share my screen. And I'm happy to be here today. Thank you to the group for allowing me to be here and to just share this opportunity with you all this evening. Kind of have a good conversation about business taxes. We'll talk through some of the basics. Open to any questions that you do have. We can save them throughout the presentation. You can write them in a chat, or if you want to wait to the end to ask questions as well too. Hopefully you're able to take away some great content from what we'll be discussing this evening.
Beautiful. Thank you. Thank you. So I'm going to put a poll up. I hope everybody is in front of their screen, and just as we move along into our Food for Thought classes, obviously hop in, join in, get what you can get, take the bites that you can take, but we want you to enjoy a full meal. So as much as you can for future classes, if you aren't already, try to be, sitting somewhere where you can take notes, where you can take part in whatever activities we have for you. We might have breakout groups in some future ones. So we want to make sure everybody is live and focused. So I'm going to get the poll started. I'm going to launch it. Just answer, and then once we get the answers from our participants, we will move on into the seminar for the night. So you should see the poll pop up on your screen. Does everyone see the polls?
Hey, Shavante, I can see it on my screen, but it's not letting me select my choices.
Let me start that over then. Okay. My apologies. I ran a test earlier and forgot to take it off launch. I was sharing results. Does everyone see it now? Are you guys able to partake in the polls now?
Yep, I just tapped in. I just finished mine. Thank you.
Thank you. If everyone else can just complete the polls, we will move on into the seminar for tonight.
Sorry, couldn't unmute, but yes, I submitted mine just now. Thank you, Evelyn, for mentioning it, because I was like, wait, I'm not able to tap on.
Right? I was like, is it my screen? Like,
I was like, is it me? I know, I kept pressing. I was like, what's going on?
Like, is it my thumb?
I was doing a test before. Sorry about that, guys. So we're almost at 100%. Just need one more, and then we will get started. Okay, I'm gonna assume that last person is not. Oh, well, they are. Thank you. Thank you for 100%. All right, guys. Without further ado, we are going to hop into tonight's workshop on business taxes. I need the gems as much as you guys. Get a pen and paper, and let's make this a fruitful 2023. Okay.
Cool, thank you. So as we discussed today, we'll be discussing business taxes 101. And with that, just move to the next slide. So with that, my name once again is Shakor Jukes. I'm a certified public accounting. Have over 7+ years of accounting experience, whether it's working in public accounting firms, private companies, Fortune 50 companies as well, through a variety of different activities within those businesses and accounting functions. But independently, I also do run my own accounting firm where I do tax work, bookkeeping, and just a variety of other special projects for small businesses like you all. And very involved. I'm local. I'm from New Jersey, New York City area. Went to school at Fairleigh Dickinson University and Montclair State University. And so the objectives for tonight and the things that I would like for you all to be able to take away from this presentation is to, one, just understand the different types of business structures, learn about the impact that bookkeeping has on tax reporting, understand the different type of business expenses, and then also learn about tax implication for independent contractors. And through that, we'll have a variety of different other topics as well too that I want to touch upon. But these are 4 key objectives in which I want to make sure that you all are able to walk away from this presentation today and learn about. And so with that said, as we begin, and the way I want to kind of structure this presentation is kind of walk through an entire life cycle of a business and how it impacts tax reporting. Tax reporting isn't just a one at the end of the year type activity. The things that you do with your business from the point of initiation and creation of your business to the point of operating activities, etc., all impact your tax implications and the type of reporting and what you have to do for taxes. And so when it comes to business structures, there are 4 key business structures from a tax perspective. We have sole proprietorships, partnerships, corporations, and S corps. And so what a sole proprietorship is essentially someone who owns an unincorporated business by himself or herself. However, they are the sole member of this. If they are the sole member of this domestic LLC and you're not a sole proprietor and you elected to be treated as a corporation, there are different rules there. And pretty much a sole proprietor is this, I like to categorize it as just a single member. You just the sole owner of an LLC, and you can have employees and things like that. And we'll talk through that later on in the presentation. But sole proprietor, I like to look at it as one individual who owns a business. And next is a partnership. Partnership, they have 2 or more people who are in business together. Both are owners or co-owners of a company or trade or business. And each person contributes money, property, labor, skills, and all that within to the business. Corporations, which is a little bit more difficult to form, but in forming a corporation, this is where you have shareholders exchange money, property, or both for capital stock. A corporation generally takes the same deduction as sole proprietorships to figure its taxable income. And there are different strategic advantages and disadvantages to a corporation. One kind of the disadvantages is not only does a corporation is taxed at the corporation level, but then when it passes distributions to its distributions as dividends to shareholders, they're also taxed at that point in time as well too. And then the last part that we do have, or the last business structure, is an S corporation. And this one is talked about a lot. And there's a variety of different tax advantages and disadvantages to S corps as well. But essentially, an S corporation, you have to elect this S corporation status. You elect to pass corporate income losses and deductions and credits to their shareholders. And the S corp, when you establish it, you can have up to 100 shareholders, and the flow of income and losses is flowed onto the personal tax returns based off ownership levels. And those individuals are taxed at their individual income tax rates. And as I mentioned, in order to establish to become an S corporation, there is an additional form that you must complete when you establish your business. So we have sole proprietorship, partnership, and corporation. And from the liability standpoint, all of them eliminates or personal liability. You're not personally liable through just different issues that arise with the business. There's unlimited personal liability for both sole proprietor and partnership, and then owners aren't liable at all for corporations and S corps. And so continue on with that same chart. Some of the benefits of a sole proprietorship, it's very low risk. It's a good choice for businesses and owners who want to just kind of test out their idea and form in a more formal business. So you have an idea, you have a business, and you think about, hey, I want to make this a more formal standpoint. Starting off with sole proprietorship is typically very low risk. There's minimum, I guess, paperwork that you have to do compared to some of the other activities. With that, taxes to be paid on it, because the taxes are passed through to your personal income tax. There are two different taxes: is the self-employment tax and a personal tax, based off your income tax rates for the year. In a tax form and where that show up, and I'll go through an example of this, is a Schedule C, which is profit from business, profit or loss from businesses. And that's included in your 1040. So there is not a separate tax form or tax reporting document. It's included in with your individual tax return. And the due dates on that is April 18th, which is your standard tax return date. For partnerships, it's also a good choice, similar to sole proprietorship. The main difference is the number of people who are owners. Partnerships have multiple owners, professional groups like attorneys, and similar, as I mentioned, in terms of the taxes to be paid. The only slight difference here is a partnership do have their own separate tax form, and that form is called a 1065, which is their partnership income tax return, and that must be filed by March 15th. There aren't any taxes that are paid directly in filing this partnership. What happens is each owner of the business get a K1, and then those K1s are flowed to those individuals' personal income tax forms. So partnership, only slight difference from a sole proprietorship is that it has its own tax form, and the due date is a month earlier, which is March 15th. And not a lot of people don't remember that, but you want to be always aware of the due dates because it does vary from your personal tax return. It's a little bit earlier. Corporations, it's a good choice for medium, high risk business. Those mainly you want to look at a corporation as a business that are either eventually going to go public. So going public means that you're going to have, stock on the stock exchange market, or you eventually expect to sell this business in some form or fashion. So you want to form a corporation. The taxes that are to be paid on here, as I mentioned, it's a corporate tax. I think the rate is around 21%, 20 something percent. And it also has its own individual tax form, and you do pay taxes through that form. And it's the 1120 corporation income tax return. The due date on that for 2023, this upcoming year, is also April 18th. And then last we have, which are S corps, and it's a good choice for businesses that otherwise will be a C corp, but there are certain criteria in which you must meet to be able to file as an S corp. The taxes that are paid are passed to those owners of the S corp, so there's only personal tax returns or personal taxes that are paid, and a tax form that is used as well is 1120S, and it's a file that's reported by March 15th. And then similar to like partnerships, you give each individual owner its own K1 that they must file in a 1040. And so those are kind of like our main key business structures. When you're thinking about creating a business, you want to first focus on what is the most advantageous business structure for me and my long-term goals. And as I mentioned, this is what a Schedule C looks like for sole proprietors. And you may have seen this form before, but if you haven't, it's pretty simple form. It has the business information, the name, address, etc. And if you don't do your own personal taxes, your accountant can walk you through this. But as I mentioned, it's only a separate schedule that's a part of your 1040 form. So there isn't a separate tax form. And all it really is taken into account is the income that came in for the business and all the expenses are associated with it. And then as you see here, if you can, this line 31 is the net profit or loss. And that ultimately gets incorporated with any other incomes that you made throughout the year for your personal self, whether this is like a side business and you have W-2 income, all that income, or if your business is at a net loss, it offsets some of that income and reduces your taxable income. And so one quick note here is a kind of did you know? So did you know that the IRS requires S Corp shareholder employees to receive a reasonable employee salary, and which generally defined as at least what other businesses pay for similar service? And so essentially, as an S Corp, if you was to establish S Corp status for your business, and you're making significant income, one of the key things you want to do is be able to pay yourself a significant salary. Well, that salary differs from distributions. And so in the S Corp, you can earn money two ways, distributions and salaries. For distributions, you do not have to pay payroll taxes. Those distributions come from your S Corp and are passed through to you to your personal taxes. Whereas salary, when you make this reasonable salary for yourself, you must pay payroll taxes on the salary like any other employee. And so essentially what you're doing is you're paying yourself a salary through your business, and you need to withhold payroll taxes and things like that. And that's where the S Corp formation becomes a little bit complex for individuals who are trying to run this business on their own, or you're trying to do things on your own. It's just the complexity of the ability to save on taxes can really be challenging to handle on your own. And that's why you have, professionals like myself, accountants, who can assist you, or there are certain automation services. So things to keep in mind is that, your total employee compensation includes salaries and bonus as well as healthcare. So not paying yourself a salary while your business earn money can be a red flag to the IRS under the S Corp status. And so that reasonable salary guideline is very broad, but what they want you to do is be able to compare it against what other businesses are paying for similar services. And so there's a lot of resources online where you can see, salary comparables and things like that. So if your business does grow to the point and where you can pay yourself a reasonable salary, you will, I think it'll be advantageous for you to do so from a tax perspective. But just one thing to note, the reasonable salary requirement is for S Corps only come into play if you take distributions from the company's profits, but also the IRS cannot impose a minimal salary requirement because if you're not making enough yet to pay yourself a reasonable salary comparable to others in your field. So it's more about as your business continue to scale and grow and you get to, making 100, 200, depends on, your business activity and what you can afford to give yourself as a reasonable salary. You just want to be aware of that if you elect the S Corp status. And so the first phase that we kind of just went through is, establishing the structure of your business. And then now, let's just say you got your business up and running, you already figured out what best status works for you. The next thing is, how do you record those business transactions? And I know it might not seem like it's directly tied to taxes, but I'll walk you through how this all kind of plays together. And so you establish the structure. Now it's okay, I need to record as business, you start having business activity, you're making sales or you're doing services and you're starting to gain money. It's like, all right, what do you do next? And the most crucial part of running a business is bookkeeping. Bookkeeping allows small businesses to stay organized, analyze financial information, and you can, make businesses decisions based off these financial records. Without business bookkeeping, it is very hard to track the necessary information that is needed to compile your taxes, to make business decisions, to get business loans, etc. And so one of the foundational components is making sure you have accurate bookkeeping and or having some type of bookkeeping mechanism within your business, because as business owners you start hitting the ground running, you just worried about bringing in revenue and making revenue, having expenses, and then at the end of the year comes, it's like, all right, it's time to do taxes. Well, if you didn't have good bookkeeping throughout the year, come tax time, it's going to be like a shit show. It's going to be really hard. It's going to be difficult. And accountants, we don't like messy work. And if it's messy, it's more time and it costs you more to complete your taxes. And so if you can get, one thing I always suggest to my clients is no matter what, having accurate bookkeeping or having some level of financial records will help you at the end of the year. Because imagine, throughout the year, you're just having business transactions from January to December. Well, when you go back and you have this bag of receipts, you don't know what that receipt from January is for. Like, it's hard to remember, hey, yeah, I bought something, but I don't know what it's for. And so now you're just kind of playing a guessing game. So bookkeeping, very crucial to businesses. And 6 ways bookkeeping help. So number one, organizing your financial records. So whether it comes time for budget, applying for loans, grants, etc., turning profit, bookkeeping allows you to find this information you need very quickly. The next one, making business decisions. Whether it's, you want to apply for a loan, whether you're making decisions on should I hire employees or submitting grant applications, having good bookkeeping and good financial records allow you to make those decisions smarter and also faster. And then third, kind of building off of number one, is creating accurate financial records. By having organized information, you can create accurate financial records. So accurate financial records could be, your income statements, your balance sheets, all those information. By being organized, you're able to give accurate information to whoever you need to present that information to. And 4, which is our topic today, is filing taxes. Filing taxes is very crucial, and business taxes can be scary, time consuming, and stressful for business owners. So if you use an accountant to file your taxes, you want your own accounting records can help with that tax filing process. It makes that process goes much more smoother, faster, and just reduces the stress and time consuming that you need to put in if you already had these business practices and good, accurate, organized financial records ahead of time. And then 5 and 6, budgeting. Just pretty simple. If you got good records, you're able to kind of forecast out how much you can expect to come in, how much you might have in expenses, and you can forecast what can you do, within the next 3 months, 6 months, or a year, if not further. And then last is getting investors. And so whether you're looking for funding in the form of owner's equity, grants, business loans, or direct investors, investors need to have a good idea of your business before investing in it. And in order for them to have a good idea of your business and your profitability and just the growth of your business, having accurate financial records is the key. And they're going to always ask for that. Whether you're looking to go get a business loan, you go to the bank, they're going to ask for your most recent taxes, any financial statements as well too, audited financial statements for some business loans. So having this information in a very clean and organized way helps with all these things, but most importantly, tax filing can really be helpful. And so these are just some examples. They're not recommendations. I'm not telling you to go out and buy these different services, but accounting software for most small businesses, can help with the multitude of all these operations, as we mentioned, including managing your expenses and also tackling tax season. And so every business is different. Every business structure is different. So some people might like QuickBooks, some people might like FreshBooks. These are just options that are out there that helps with that automation and simplicity especially for small businesses, entrepreneurs, people are looking to grow. These different services have different levels of access and which can be very beneficial to you as a business owner, and thinking about just the different software you should invest to have accurate financial records and bookkeeping, to ultimately at the end, when it comes tax time, you can just print out a report and just hand it over to your accountant and say, hey, this is my business activity for the year. And they can, seamlessly do your taxes. And so moving on, the next phase. So we talked through business structure. We talked through, all right, now that your business is up and running, you have some, you're starting to keep financial records, accurate financial keeping. The next thing I want to talk about is expenses. So expenses in a business are really crucial. It kind of helps offset some of that income. But one of the biggest tax myths, and I hear this a lot with clients, is that tax write-offs. I personally hate the word write-off, but people love the name. It just sounds very cliche-ish. But a tax so a myth that stands out there is a tax write-off means that the item doesn't cost the taxpayer anything. Well, if this was true, when it's not, the government will be paying for all our business expenses. The term write-off is very commonly used, but a more accurate term for write-off is tax deduction. And the truth behind the statement is that taxpayers receive a tax deduction for legitimate business expenses. A tax deduction lowers taxable income. Or a more simplified way of saying that is that as you make business purchases, these purchases can reduce your income tax obligation. It doesn't mean you don't. So if you go out and say, hey, I'm about to go buy a G-Wagon for my business and I'm going to write it off. Yeah, you still have to pay for that G-Wagon. If it's going to cost you 100 grand, you still have to pay that bank 100 grand. But yes, if it's a legitimate business expense, you're able to reduce your income tax obligations by that expense amount. Now, something like a car, 100 grand, there are certain rules of, amortization, and, you have to prorate that cost over, 5 years or so, but it does allow you to reduce your income tax obligation, but it does not mean it doesn't cost you anything. Whatever you purchase, you still have to pay for that purchase. It just, on the flip side, you're allow a business deduction that will help reduce your taxable income. And so continue on with that as a thought. Business expenses. Business expenses are costs of carrying on a trade or business that are usually deductible if the business is operating at a profit. So if you got all this income coming in and you're like, man, that tax, I'm making all this money, how can I reduce or how can I offset some of this income coming in? This is where your business expenses coming in. So you're getting all these services, but maybe you got to travel, maybe you have to invest in software, buy certain supplies and things like that. All those legitimate business expenses offsets that taxable income that ultimately helps you either end up with a net profit or net loss when it comes to reporting your taxes. And so what we have here is personal versus business expenses. And this is also, and I'm not, this presentation, we're not going to go into detail about all the different type of business expenses. I really wanted to include in some really key high level items about expenses that are really like talked about within the profession or even with clients. And so personal versus business expenses. I'm a person who always recommend do not commingle your personal expenses with your business expenses. So when you think about creating your business or establishing your business, I always prefer that my clients have a separate bank account for their business income and expenses, because when you start looking at your bank statements and things like that, you're making money. You might, have other businesses, or you might have other streams of income that you're depositing into your personal account. And so by separating it out, it makes for clean and organized financial record keeping. And so generally, as a business owner, you cannot deduct personal, living, or family expenses. However, if there is an expense for something that is used partly for business and partly for personal purposes, the total cost can be divided between business and personal parts, and the business part may be deducted for income tax purposes. And so, as I mentioned, it can be really difficult to track and distinguish between what's personal and what's business related. So to, give yourself the simplicity and the easiness, just keep them apart. But should you have an expense that is both for your personal use, but also for your business use, and we'll get into in the next slide, home office deductions, because, that tends to be kind of personal and business. But you want to make sure that you're able to distinguish how much of that expense was for personal use and how much was it for business use. And so example here, if a business was to borrow money and you use 70% of it for his business and the other 30% for a family vacation, then a 70% of interest is deductible as a business expense, but the remaining 30% is personal interest and not deductible for business purposes. And so that shows you that kind of distinguishedness between business use and personal use. You as a business owner, you got money or you borrow money, but you utilize it for two different reasons. So you want to keep it separate. That 70% can truly be deducted as business expense, but that other 30 that is utilized for personal cannot be deducted. And so the next thing, home office deduction. This has been a big one. A lot of us during the pandemic working from home, or people are creating businesses and just running in and out of their homes. They're not, physical locations. So if you do operate your business out of your home, a portion of your expenses of the residence may be allocated to your business. However, the taxpayer must prove that such portion of the home is exclusively and regularly for business purposes. And so the tax form that you put this information into, it's called the Form 8829. It's also a part of your regular income tax filing. There isn't a separate tax. This form gets included inside your 1040. And they're truly the two basic requirements to qualify for this deduction is that there must be exclusive use of a portion of your house for conducting business on a regular basis. And then the second piece is that the home must be the taxpayer's principal place of business. And so you can also meet this requirement if you're only, if you're doing administrative and management activities that are conducted at your home there, and there's no other location to perform these duties. And so essentially what that's saying, if your principal place of business, let's just say you go visit your clients at different sites and things like that, but your home office or where you do your administrative and management activities is at your home, you can still meet this requirement. You do not have to actually physically perform those activities at your house. And so another expense, and this is for people as you continue to look to grow and scale your business, is employees. And so if a business have employees, it must withhold various taxes from their pay. And so these type of employees, what we call employees, are people you give W-2s to. And so what I'll go through in the next few slides after this is about self-employed or contractor work. And so there are two type of employees or individuals that you can have work for you. But in this instance, what we consider employees are people you give a W-2 to. And so those people, you must withhold the employee's share of Social Security and Medicare taxes, along with state and federal income taxes. And trust me, this sounds like a lot. It is a lot for, as a business owner, if you look and hire people and bring them on. You want to invest in payroll software that simplifies this for you, automates it, takes the burden out of you having to remit these taxes, whether it's monthly, quarterly, to the state and federal. There are softwares that can assist you in doing these things. And so my thing is that as a business owner, you're focused on prioritizing and growing your business. And so one of the things you want to think about is, hiring this employee, what is the additional cost between them being employees, or what I'll get into next, which are independent contractors, and the amount of paperwork and activities and the benefits that go into each one of them. And I do see questions in a chat, and I will get to them in a few minutes. So thank you for kind of asking questions. I will make sure I address your questions before we adjourn here today. And so with that, just want to go through a couple more slides. So the next one I talked about, so we talked about employees. The next thing I want to talk about is independent contractors. Independent contractors are basically people who are self-employed. And what that means is I like to consider them a 1099 worker. And so a 1099 worker is one that is not considered an employee. Rather, this type of worker is usually referred to as a freelancer, independent contractor, or self-employed worker that completes particular jobs on assignments. And so you can decide, hey, instead of investing full-time into an employee and paying them a salary, you can hire a contractor or a freelancer or the self-employed individual, where as a business owner, when you hire these individuals, you do not have to withhold, state or federal income taxes. That burden is pushed on the actual 1099 worker. And so with that, if you're paying this person over $600 or more over the course of the year, you must issue them a 1099, because issuing them this 1099 allows you to take the tax deduction or the business expense that you're paying these individuals for their services. It allows you to take that and accurately report it, but also allows this individual to claim it on their income taxes. And so this is what the 1099 form looks like. If you haven't seen one before, it just has like the individual's name, and pretty much most of them just have box 1 completed with the compensation that they were paid for the year. And so the tax implication for a self-employed individual, they are responsible for paying their own self-employment taxes. And this covers amounts that they owe for Social Security or Medicare taxes for the year. And so my recommendation to individuals who are 1099 workers, and if you do decide to have your do hire contractors versus employees, one thing you just want to help them, I like to inform them of how it impacts them from a tax perspective, because as you business owners, you're not withholding taxes. And so therefore somebody is required at the end of the year, the government is like, hey, you got paid, $2,000, but no taxes was withheld from it. And so now that 1099 workers now have to, to either pay taxes or most likely they'll owe taxes because they didn't have anything withheld. And so I always recommend tax planning for those individuals, because it helps them estimate as they make all this self-employed, freelance, contractor work throughout the year, and they just, getting all this 1099 income and no taxes are being withheld. Tax planning helps them estimate how much they'll need to pay at the end of the year. And so developing either some type of bulletproof savings plan as they make this income, they're setting aside money. So when it does come time for taxes, that they can, be able to afford whatever taxes that they owe. And depending on how much, these self-employed individuals are making throughout the year, the government do require them to pay estimated quarterly tax payments. And the reason for this is, let's just say you made, $60,000 in self-employed income as a 1099 worker, but you never had any taxes withheld. And so now you go to file your taxes or complete your taxes, and now you're stuck with this huge tax bill. Let's just say $10,000. Well, most people, you can't just pull out, $10,000 out your pocket or whatever. And so with the government, the way they kind of help you alleviate that burden is on an estimated, on a quarterly basis, you make these estimated tax payments. So you're basically paying taxes in advance on a quarterly basis, Q1, Q2, Q3. And so when you go to file your taxes, you already made tax payments throughout the year. And so when you get to the end of the year, if your estimation was pretty in line, you may get back a little bit of refund, or you might, owe just a little bit amount, let's just say a couple $100 versus having this huge tax bill. And so that's really the reason behind those estimated quarterly tax payments. And so as we kind of get to the tail end of our presentation today, as business owners, when you prepare yourself for the tax return preparation process, I broke it down in two pretty simple steps: gather and choose. Gather means gather your financial documents, your financial records, collect all your receipts, organize them. If you're doing itemized deductions, or, locate a copy of your last year taxes for personal, for personal reference. Kind of list out any personal information if you have houses, social security numbers, all that stuff. But start gathering your documents. And then as you're in that gathering phase, the next step is to choose a tax preparer. So this is for people who don't complete their own tax returns. Does a bank statement suffice in place of a receipt? Yes, it does. Yes, you can share that with your accountant. They normally can help assist you in that way, because you did spend the money. So it is a supporting document that show that it was an accurate expense. And so the last piece, choosing your tax preparer. Schedule an appointment to understand that tax preparer's process and costs. Understand if you would need extensions. Extensions normally come in due to timeliness. So let's say you wait to, April 1st to, finally identify an accountant. Well, by that time, we're pretty slammed. Everybody, it's tax season, the filing dates is April 18th. And so everybody's trying to get in at the last minute, which I do not recommend, because you might end up on that extension list. It's nothing wrong with being, extended, but most people, we want if you're getting a refund, you want your money as early as possible. You don't want to have to wait until later into the summer and things like that. And so I recommend you reach out to tax preparers as soon, as early as possible, to start getting on that calendar, understand that process, and really interview the tax preparer. We all are performing the same services, but how we go about providing that service to you as business owners, as clients, it varies by firm. And so my recommendation is choose a tax preparer that fits what you're looking to achieve, and understand their process and understand their costs, and then plan ahead for any tax refunds or tax that you may potentially owe. And so this one, this slide here is another did you know as it relates to sales taxes. This one is a little bit more unique. If your business, if you do collect sales taxes, you are required to remit those sales taxes to your state government on a regular basis. And that can be whether it's monthly, quarterly, or annual. Sales taxes are essentially pass-through taxes. These taxes are passed through onto the customer during a transaction. Customers, not businesses, pay these sales taxes. But however, as a business owner, you must collect, deposit, and report these sales taxes. And so my recommendation, if you are in a business where you are collecting sales taxes on your sales of products or services that you're giving to customers, and you're collecting sales taxes, that sales tax money is not your money. That's just a pass-through tax from the government to the customer. That money is not yours as a business owner. You must report any sales taxes that you do accumulate. And so my recommendation, consult with your state government authorities or accountants within your area to understand the sales tax remittance process. It varies by state, so depending on where you're located, New York, New Jersey, Connecticut, all across the US, they do vary in terms of reporting sales taxes. So you want to understand what that process looks like and how often do you have to remit and produce those results to the your state government. Oh, sorry. So last slide here, final thoughts for me. I know I just kind of gave you a lot of information in a short period of time, but hopefully this was really thoughtful and really help answer some of your questions. But my final thoughts is choose a business structure that aligns with your business goals. Each have their own individual benefits. Managing your company financial records properly is essential. Having bad books can equal bad tax reporting. Consider your tax implications all year round. Do not just wait till the end of the year to say, hey, does this what I did in January benefit me from a tax perspective? As we kind of walk through this presentation, the moment you initiate your business to all the activity and what you have throughout the year, all impacts and all somehow ends back up impacting your taxes. And so do not think of taxes as a once a year type activity. As a business owner, think about it all year round as you're doing certain things, making certain purchases, investing in different ways in your business. You want to understand, how does that benefit you from a tax perspective, or does it, put you in some type of tax jam? And last but not least, consult with an accountant. Some accountants are really truly here to help and assist you. As business owners, you're the mind of the business, you're the creator, and not everybody is good at the tax or the finances of the business. And so as you continue to scale and grow your business, having an accountant that you can trust is truly valuable and will help you propel you even further. And before we get into questions, if you ever need to contact me, there's 3 different ways. I have a website, jukescpa.com, or if you want to email me, Shakor at jukescpa.com. And then if you want to connect with me on Instagram, my Instagram is also jukescpa. And so appreciate it. It was really good chatting with you all. I do want to go through some of your questions, so feel free to get on mic and ask some of the questions. I can still go through the chat to kind of answer them, but hopefully you all really appreciate it. And it was great kind of chatting with y'all all today.
Thank you.